Hello and welcome to another episode of the Ideal Investor Show. I'm bringing on a guest today that is actually answering the question, what happens if we finally reach this time freedom point that I'm always talking about, and that we take our mentoring clients on that journey, on the investor journey to reach the time freedom point. But let's assume you reach the time freedom point and you can basically decide, okay, I want to kind of retire, or I want to do other things with my time rather than having a job. What do I do then? And David Rosell, our guest today, is an expert in exactly that. And he is also the author of the book, Failure is Not an Option. So we will talk about what can people do to really enjoy the time after you reach the time freedom point. And I'm sure you're going to be very interested to hear what he can share and what his wisdom has become for this particular area. Hello and welcome to another episode of the Ideal Investor Show. Today we have a great guest. David Rosell is with us, and he is an amazing traveler around the world. And we want to learn a little bit about what he has learned on his travels and from helping other people do investments. So David, welcome to the show.
Axel, it's a pleasure to be on your show today. Thanks for having me.
Yeah, thank you for making the time, especially relatively early in the morning. So where are we finding you right now?
I'm in beautiful Bend, Oregon, which is in the mountains in Central Oregon.
So has it been as hot as they say about Portland and some of the other places?
We usually have a temperate climate, but we've gotten as high as 105 degrees over the past 2 weeks. And we have some thunderstorms which are rolling in, which is also rare for us. And unfortunately, the lightning often causes some forest fires, as you're aware of down in California.
Yeah, we have been very fortunate here in my area in North San Diego County that we haven't had anything major in the last 5-6 years. But yeah, as everybody knows about California, there is plenty of places that have really been quite devastated several times in a row. So, well, for our show today, I wanted to first maybe start out to ask you, tell us a little bit, how did you get into traveling? I think I saw 75 countries, 6 continents and stuff like that. How did that happen, and how does that relate to helping people invest?
Yeah, so it all goes back into my youth. I started my first business at the age of 15, and it was seal coating driveways, where we took this black rubberized material in 5-gallon buckets and spread it on driveways. And I did it through high school, where we first did 8 driveways that first summer, and then did it through college and started hiring friends to help me. And by the time I graduated college, I was making pretty good money for a young guy. We were doing about 125 driveways a summer. And then after graduation, I said to my parents, I'm going to do driveways one more year. And during the off season, instead of looking when the snow came as a detriment and having to shut down operations, I looked at it as an opportunity to go travel.
I see.
So my first trip was to Australia and New Zealand, because that was low-hanging fruit, where they speak English and beautiful nature. And then I would meet people coming in from Southeast Asia. And if you would have told me at that time that I would grow the business for another 10 years and spend a month in 65 countries over that 10-year period, I would have said, Axel, you're crazy.
Okay. So did they hang upside down there, or how was that?
Down under. Well, the toilets definitely flush in the opposite direction. I found that out. And I learned to say that they don't drive on the wrong side of the road. They drive on the other side of the road.
Oh, they didn't like the wrong side. I did a lot of work in the UK, and I had to learn that too, together with the Queen's English versus what I had learned here. So.
Yes. And I learned about those old English cars, because I own one myself, that if they're not leaking oil, it means there's no oil in the engine.
Yeah. Yeah, that's a good point. So, like I said in the initial question, you kept doing your business and you kept doing the traveling. When did that transition to helping people to invest start?
Well, it started much earlier. I was 19. I was still in college. I was making very good money, as I alluded to, for a young man. And I got the permission from the bank to loan me money to go out and buy a brand new Honda Prelude.
Okay.
And I'll never forget the conversation my grandmother had. She was well ahead of her times. And she showed me this chart and taught me what an IRA was.
Okay.
And it illustrated that if I started at 19, and at the time you could fund it up to only $2,000 per year, and stopped when you were 27 and never funded it again and received the stock market average at that time of 10%, I'd have over $1 million by the time I hit retirement age. And she really taught me in my youth, and so did my father, that you don't really need to do anything extraordinary to accumulate a comfortable lifestyle. We only need to do some ordinary things extraordinarily well, like live on 90% of our paycheck instead of 100 or 110%, and put that money to work for you.
Right. Okay. And when we talk about putting it to work for us or for our clients, do you have any preferred ways that you would say, okay, this is my go-to thing, or what's kind of the spread that you're recommending?
Well, there is no the way to do investing. There's no the way to do anything, but we do have our own preferred way. The focus of my particular practice, which has evolved over the last 22 years, is now we have a niche, and that is for people who are at or near retirement. They've already accumulated a certain amount of wealth, and now they're going to be living off of that wealth for the rest of their lives, which is often 2, 3, and sometimes 4+ decades. So the financial tools and strategies that help people get up the financial mountain in the accumulation phase may not be the most appropriate investments for the distribution phase.
Right.
But if I were to name an investment that all of our clients own, and that I think that if people aren't aware of, they should certainly look into and educate themselves on, that would be exchange traded funds.
Okay, cool. Yeah, and we can go into that a little more in a minute. But since you started talking about the mountain and getting to the place where you can start drawing and so forth, you mentioned there's a little story there about mountaineering. So maybe this is a good segue to say, how does that story go?
Yeah, I grew up in the Adirondack Mountains of upstate New York, near Lake Placid, where the Winter Olympics were.
Okay, cool. Yeah.
And our tallest mountain there is just over 4,000 feet. Still steep mountains to climb, but nothing like many of the other mountains, certainly the Alps and the Himalayas. And when I did that first trip in New Zealand, I did a lot of what they call tramping down there. And I really fell in love with climbing these mountains. And several years later, life found me doing the Annapurna Circuit, a 21-day self-guided climb through the Himalayas. And over time, I started reading books about mountaineering. And my hero in that world has always been a gentleman named Ed Viesturs.
Okay.
Have you heard of that man?
No, but I know of a pretty famous German mountaineer who...
Reinhold Messner.
Yeah, exactly. And I really loved his books too, that he always had such a vivid way of describing their challenges and kind of like how the mindset and view on things changes when you're exposing yourself on the one hand to these kind of environments, but also he may have seen in what he wrote, like, things like self-reflection, quietness, conquering things when your body seems to say it can't go any further, those kind of things. So
yeah, Reinhold Messner and Ed Viesturs certainly have a friendship that goes back far. And you talk about mindset, and one of the things that these great mountaineers have in common is their biggest muscle is certainly between their ears. You got to have a certain mindset and mental strength to accomplish what they did. And Ed Viesturs is the only human being who has summited Everest 7 times without supplemental oxygen. His books are remarkable as well. I'll never forget the time I had an opportunity to meet with Ed on several occasions. And he said to me that most people think his goal is to get to the summit. But he said that is not the goal of any experienced mountaineer, because when we get to the summit, we still have the second half of the journey left. And 80% of the accidents and 80% of the deaths happen on the descent.
Yeah.
So he said, our goal is to summit, but get back down alive to our friends and family. Cool. And when Ed said that it's the second half of his journey that takes on the most amount of risks and needs the most amount of planning, that was my aha moment to write my first book titled Failure is Not an Option. And what I realized is that it's the second half of the financial journey, when you're no longer adding to your IRAs and 401ks and now going to be living off those funds for those up to 4 decades.
Right.
It's that second stage of the descent that also takes on the most amount of risk and needs the most amount of planning.
And then would we then stretch the analogy a little bit to say the higher the mountain, then the longer the inevitable end can be delayed?
I guess are you alluding to the higher the mountain, meaning the more that you're asking to live on each year in retirement?
Well, if it's halfway to get to the summit and the other half is to get down, right? And you said 80% in mountaineering, I think in retirement, it's 100%, when you get to the bottom, ultimately, then most people don't make it beyond, so.
Right.
So the higher the mountain, I would think the longer the track to come back down. And hopefully that's then 40 years or even more in some cases.
Oh, right. Yep. And longevity is certainly one of the key 8 risks that I write about because people are retiring earlier and living longer and longer. Another one is, when market volatility, which we've been experiencing this year, is taking place, which takes place 1 out of every 4 years, the market ends up in negative territory and 3 out of 4 years in positive territory. When the market is down, say 20%, and you're on the accumulation phase climbing the mountain, I hope that listeners are realizing in that stage of life that is a bonus. Because if you're funding your 401k each and every period, you're getting 20% more shares that pay period with every dollar that you're investing in your 401k. However, when you're on the descent and you're living off of that 401k and the markets are down 20%, you need to liquidate 20% more shares to get that same $10,000 that month. And that can have a detrimental impact on retirement if you haven't planned for it appropriately.
Right, absolutely. And I mean, I would say you probably, as much as I have kept pounding this dollar cost averaging benefit, so to speak, of, lower prices give you more of whatever the asset is that you're accumulating. Now, I want to ask, you mentioned IRA, which I know is, from my perspective, maybe a little better, but you also just mentioned 401k. What's your thinking about this notion of we're deferring the tax because we're assuming that we're going to have a lower tax by the time you get to retirement? Do you subscribe to that or not so much, or what's your thinking on that?
Well, there's something called Diversification 2.0 that I write about. Diversification 1.0 is owning all 24 asset classes and rebalancing. That concept won a Nobel Prize in economics called the modern portfolio theory. But most people, by the time they hit retirement, have a majority of their funds in a retirement-like qualified plan, like an IRA or 401k. And I love those accounts. But what happens is when you take distributions out of those accounts, every dollar coming out gets taxed at the highest rate of ordinary income. Now, everything has its pros and cons. The pros is that money has been tax deferred and mushrooming over those years. You got a tax benefit when you funded those accounts. If you earned $100,000 and put $10,000 into your 401k, you only paid taxes on $90,000. But when people have almost all their dollars in that qualified retirement account, by the time they hit the top of the financial mountain, they have to liquidate a whole lot more out of their 401k to get that $100,000. So what we believe is while you're in the accumulation phase, Diversification 2.0 means paying tribute and having funds in all 3 different types of taxable accounts. That includes an IRA, which grows tax deferred, as we talked about, and gets distributed at ordinary income. And then you got brokerage accounts where you have no upfront benefit, but you're only taxed on the capital gains rate, a much lower rate on just the gains. And then there's tax-free accounts, one of them being a Roth IRA. And when you pay tribute to that, you could potentially cut your tax bill in half in retirement when you're taking a chunk that you need from each one of those 3 accounts.
Right. Yeah, I think that's very well explained. Thank you for making that very clear. I also believe, to put a little my own opinion in, that the assumption, and that depends a little bit on how far away we are as an investor from retirement, but the assumption that the overall bigger macro environment will allow tax rates to remain where they are right now. If we, for example, use the income tax rate that you just referred to, that would be used for some of the taxable returns, so to speak, that people take out of these accounts, I'm pretty sure with like 30 trillion in debt that at some point, sooner or later, we will not get along with the current level of taxes that people are being asked to pay. And history shows that taxes used to be way higher than they are right now. So that's one other aspect to consider, I believe, when you say, okay, well, what will be the actual rate? Even if you look at the categories and say, okay, well, some of it will have capital gains tax, some of it will have income tax, some of it I already paid my taxes, so it's done. So I'm just basically taking money like I took it out of a savings account. But if the taxes increase significantly, which I believe is quite likely, if, for example, your horizon is like 10 years or beyond from the audience, somebody who says, well, when will you retire? Is it 10 years, 15 years, 20 years from now, or is it 5 years from now? So that, I believe, makes a difference in that context. Now, with that being said, you basically talked about these different categories of accounts. What about other asset classes? What are your thoughts about that?
So we're talking about asset classes to invest in, not the taxable asset class.
When before we start, you said ETF, and there's obviously ETFs for all kinds of mixtures, almost like your little personal mutual fund kind of thing, but you can have a gold or silver ETF. You could have other ETFs with other assets in it, or you could go away from the general stock market type of investments into where we are living for the most part, which is what I would call value assets like real estate investments or other tangible value assets. So what are your thoughts about those?
Yeah, well, we're a firm believer. All of our clients own all 24 asset classes and rebalancing. The reason we have asset classes in there that are uncorrelated to the stock market, things like real estate, natural resources, gold, timber, is by being uncorrelated, they give us the opportunity over time for higher rates of return while lowering the overall standard deviation or risk. Every asset class has its pros and cons. What's on top one year is usually down the next year. There is no one best asset class. We own them all, and then we rebalance.
I would subscribe to that as well. And I think the other part, besides, which one is doing well right now and which one is not doing so well right now, is also that they are treated differently, right? Like when we looked at, you mentioned 401k and IRA as, for example, one aspect. If I look at our real estate stuff and how the government is treating people who are investing in real estate to provide shelter is very different than they treat stocks, for example, right? And with depreciation and the way capital gains is one aspect of it. You can transfer with a 1031 exchange, so you don't even have to pay the tax until you're actually claiming that you no longer want to actually make significant changes and start basically drawing, so to speak. So all these kind of different things I think are quite important. So when we look at the community, I said in the beginning, you are typically working with people who are pretty well off, high income earners, high value asset holders. Our audience is typically a little bit more on the middle level or lower income level. So their contributions to any plans or any of the asset classes are typically not that big. Now, one thing I heard, or basically paraphrasing what you said, is the earlier you start, you don't need to do extraordinary things to get to a really desirable outcome. What other kind of nuggets along those lines for people who are not already in the high income earner class would you share?
Yeah, well, it alludes back to the tougher we are on ourselves today, the easier life will be on us later. Investing into real estate, investing into your qualified retirement accounts is imperative if one day you're going to be independent of the paycheck and live the life you've always imagined. It's not going to just happen. If it is to be, it is up to me. Every different type of investment has its pros and has its cons. There is no the best. So I recommend investing into real estate. I recommend investing into IRAs and 401ks and brokerage accounts and having a diversified portfolio. In 2008, when the stock market and the real estate market both crashed by over 50%, you had bonds up 18%.
Right.
So by owning a diversified portfolio, there's always something to kind of keep us from sinking.
Yeah, absolutely. I totally agree with that, David. Going a little beyond that, one of the things that I'm detecting, and it may be a little bit, might have to do with a generational shift, but it appears to me, and I'm curious what you would say, that there seems to be a growing impatience in younger generations when you and I say, well, you want to start early and you want to invest. And if you do it and you're willing to take that little bit, let's say, sacrifice, so to speak, I always say, I kind of think you say the same, pay yourself first with the first 10% that comes in and then use the remaining 90% or whatever that number might be to do the rest of your life expenses. But there is a certain patience required. So what's your experience about, the shifting perception of how patient can we be or do we need to be to get to a point where either the routine becomes a routine, which is kind of what I always say, if it's your normal life, you wouldn't even miss those 10% anymore after a while. But then on the other hand, when you say, well, how long do I need to be patient? 7 years, 8 years, 10 years, 15 years. What's your recommendation for people who say, well, that sounds so long, I can't even imagine?
Yeah, well, one of the biggest challenges I think we faced in our society is we never are really taught much about money.
Absolutely.
And, the average person is going to earn millions of dollars in their career, but we're not taught in school about the power of compound interest in the law of 72. I could only share how I help my 2 children. My daughter is 21 and my son is 18. And I've done my best to try and brainwash them at a young age on the importance of patience and how these formulas work that my father and grandfather taught me. But now that I have them involved in the markets for the last several years, is if my son, who works at a coffee shop in the summer, earns $300, we take $100, a third, and it goes into his checking account, and he can have fun and do whatever he wants with that. Another $100 goes into a savings account for when his vehicle breaks down. He's not coming to mom and dad asking for money. And the other $100 goes into a tax-free Roth IRA invested into the S&P 500 ETF, which costs almost nothing to own. And every $100 he puts into that, I double it and put $200 into his account. So he's already making 100% on his money. And he is learning the difference of working for money, which he does at the coffee shop, and having money work for him while he's at the coffee shop and the markets are up. The markets are up almost 500% since the lows of 2009. And so people have made 5 times that money. And if it's in a Roth, it's completely tax-free.
So that's David Rosell's little 4-quadrant method. So a little bit. Cool. Yeah, that's very good. Now, you touched a little bit on the bigger picture, and obviously for your kids, they have that long horizon. I personally believe we are seeing and living right now through times that are probably more change. Change has always been there. It feels to me that there's more change in the economy, like this whole globalization thing seems to be shifting a little bit. The markets seem to be shifting. The intention to produce at home rather than having everything that is conceivably possibly produced somewhere else for cheaper labor seems to be shifting. The way people actually allocate their money and how much money they have, literally expendable or usable versus what they believe they need, seems to be shifting. So to me, and I'm a big fan of like the Fourth Turning and Sovereign Individual and those kind of writings. I'm curious, David Rosell, what you say, where do you see the macro going in maybe the next, let's say, 3 to 5 years?
Well, I certainly agree with you that the only thing constant in life is change. A lot of the changes happening here in the United States as well as abroad are daunting, and it makes me concerned for our youth. With that being said, the 4 most expensive words in the English language are, this time is different. Every time when we are facing a major crisis, call it the Great Depression, call it World War I, World War II, Vietnam, call it that crazy Monday in 1987 when the markets crashed more in one morning than ever in history. And then let's go on to 9/11. Never before has there been a terrorist attack on American soil. This time is different. Get into cash. And then let's take a look at 2008. Never before has the largest insurance and investment and financial companies in every sector either declared bankruptcy or no longer exist. Axel, this time is different.
Right.
And the last example I want to use is COVID. In March of 2020, when we realized COVID is a reality, the markets dropped 34% in 1 week. And everyone said, this time is different. Get out of your 401ks, get out of your IRAs and go into cash. And guess what? The markets are up almost 80% in the last 27 months as of today. It's the 4 most expensive words in the English language. And every time when we're in the thick of those huge worldwide events, we always think that this is unprecedented. It is unprecedented. But I want to share with the listeners, in the history of the world, there has never been a down real estate market. There's never been a down stock market that hasn't rebounded to hit an all-time high.
Yeah, I'm with you completely. And that's why I think we're talking about rebalancing assets rather than some people constantly seem to want to convince us that we need to get rid of or out of certain assets. And, especially if you consider cash an asset, which some do, some don't. So you're constantly supposed to pull everything into cash and then wait what happens, which is probably the worst thing you can do. But the rebalancing, I think that is a great message also for our audience in general. And I'm talking about it all the time. You call it accumulation phase, investing phase, basically distribution phase, or on the, after the peak coming down the mountain. Those, I think, are really the important messages today from our conversation, as well as long term, because if people, I believe, follow that advice that you gave, that I'm keep pounding on, then they might be in a minority, but I'm pretty sure they're going to smile all the way down the mountain. With that being said, we always ask 2 questions at the end of our podcast. And so I want to ask you, David, those 2 questions as well. If you could meet anybody, present or past, who would it be and why?
I'm laughing here because that's a question that I often ask when I'm interviewing a new potential candidate to come work for our firm.
Okay.
If I could meet anyone, dead or alive, that person would be Dr. Wayne Dyer.
Oh, really? Oh, cool.
Yeah. Wayne Dyer, as you might know, was a world famous philosopher. He passed away 5 years ago. And he had a really big impact on my life. His philosophy was remember yesterday, dream about tomorrow, but live today. And I'll never forget what he said. I once heard him live in an audience, and he said, the least selfish thing we can do in this lifetime is be happy. And I thought to myself, that sounds more selfish. And he went on to say that when we're happy, we are not a burden on anybody. And he asked us to think about, who is the most unhappy person that you know that comes to mind? Are they a burden on anyone? And I said, of course they are. Right. And then he said, who's the happiest person you know? And whoever comes to mind, he then said, are they a burden on anybody? And I said, of course not. And it made me realize that the most selfless thing we can do in this lifetime, even during these crazy events going on, is be happy.
Yeah, absolutely. I subscribe to that. I was very fortunate to be in his presence twice myself while he was alive. And I love his books and the philosophy that he has. So yeah, I might actually come along. I've said that so many times on podcasts. I would probably be constantly just meeting all these people that other people like to meet. But yeah, he is a really, really profound person. But for me, profound always means when somebody says something and it sounded like you were a little bit in that same corner. And initially you have a reaction and then you kind of dial back a little and reflect a little and then you have the real reaction. So he was fabulous in that. The other question that I always ask, the last one I promise for today's podcast, is if you had a time machine, you could go anywhere. You just can't change the space-time continuum, but you can go anywhere, forward, backward. Where would you go and why?
Oh, I know that most people probably say they'd love to go in the future and see where we're going to be in 100, 150 years. I would go back in time. I would go back to a time where there were still some comforts in the world. I'd probably go back 250 years ago, really, when our country was getting started. And although life was harder in many ways, it was simpler and in certain ways a more beautiful life. There were certainly no iPads, iPhones, and no IRAs. Right. And I think that innocence, we all try and get away and connect with nature when we're not working, or most of us do, so that we can have a more simplistic experience. And I'd be all in favor of that.
Yeah, absolutely. Yeah, I can tell you because I'm asking that question all the time and we've done a lot of podcasts. It's probably about 40% people wanting to go into the future, not very far, but more to see what came of my kids or what came of this investment idea or what came of this business that I started or stuff like that. And 60% going, this is just rough, not empirical, but just gut feeling, rough estimate, going back to some point to be in the presence of some circumstance or some sort of environment. So yeah, that sounded very good. And maybe at some point when these kind of crazy technologists figure out a way for time travel, we can do something like that.
Absolutely.
So with that being said, thank you again, David, for coming on the show. Now, how can people who really like what you told us, your wisdom, and maybe also interest in how you handle these 24 different asset classes and the balancing and rebalancing, how can people get in touch with you?
Well, there's a couple ways. One is they can find our 3 books that I've written on Amazon or Barnes & Noble. The first one is called Failure's Not an Option, Creating Certainty in the Uncertainty of Retirement. And another one is for our clients' children and grandchildren called Keep Climbing, a Millennial's Guide to Financial Planning. But they can find us online at rosellwealthmanagement.com. And Rosell is ROSELL, wealthmanagement.com. And I always invite people, if they just want to reach out to us, they can reach me at the office at 541-385-8831.
Awesome. Thank you, David. And for those people who like to go and see good pictures, I have to give you kudos for the really awesome pictures on your website that I saw, obviously from your travels, I'm assuming.
Well, Axel, I know that 3 decades ago, you were residing and you're originally from Germany. And one of the stories I write about in the book is I was one of the privileged few that had an opportunity to be in Berlin on November 9th, 1989, and partake in the chopping down of the Berlin Wall. And that was one of the most memorable and surreal experiences of my life.
Yeah, well, I wasn't right in Berlin, but I was in Germany at the time, and it was crazy, especially since I was in the Air Force and I had always trained for these like big red bear people coming across and overrunning us. And suddenly there was supposedly freedom there. So that was definitely a huge thing. Maybe a topic for another podcast in the future, David.
Lots of champagne and lots of good German beer.
Yeah, exactly. Cool. Well, with that being said, I think that's a perfect ending. David, thank you so much for making the time coming on the show. And I hope we can do it again sometime.
I would like that, Axel. Thanks for having me today.
Absolutely. Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.